Rahul Sharma, who's the Director and Head of Research at GM Financial, who joins us on the show. Rahul, good morning and thanks for taking the time out. Rahul, we were going through one of your notes that you picked up. Firstly, a happy Dhanteras to you as well as season's greetings. We were going through the recent note that you put up, and you certainly seem positive. There is a suggestion that at least in the near term, the pain is out of the picture. Can you tell us about everything that you are looking at when it comes to markets right now?
Yes, best wishes for Dhanteras and the festive season ahead. Now, clearly, if we see what caused the problem in the first place in the October series was the heavyweight Reliance witnessing selling pressure, decadal high open interest on the short side. Clearly, that is about to reverse as we are witnessing a triple bottom divergence on the daily charts. So, the pain point may not be a pain point anymore, which means that the Nifty downside remains limited. Point number two, it was the FIs which were selling both in the cash and as well as in the derivative segment. Now, that aggression has come down significantly. So, if you see the Nifty index futures positions, the short position that the FIs were holding, so that has been trending down over the last few trading sessions. And also the cash numbers that we were seeing, the big cash selling numbers that we were seeing, they have also come down to relatively smaller manageable numbers, which again is a green shoot. Apart from that, if you remember the 23rd of July, which was when we had the budget day low, especially on the Nifty 500 index, has not been breached. Nifty did breach that, but the Nifty 500, which is a broader market index, 500 stocks in that index has formed a double bottom around the budget day low. Now, lastly, everything put together, what we feel is the Nifty futures open interest is at a month low. So all the weak hands are out of the system. Capitulation more or less has happened. Maybe the F&O expiry will put more light on that if the rollovers tend to be lower than the average of last 3 months. That will add even more conviction. But having said that, what we saw on Friday seems like the worst is behind us. We may see a bit more volatility, especially because Bank Nifty is not completely done yet. Bank Nifty may witness another round of selling just before the expiry, which is tomorrow. But 24,000, if Nifty touches once again, if comes closer to it once again, it will be a brilliant opportunity to enter into longs. Now, how could you enter into these longs? Two ways to do it. One is simply be an investor and buy the Diwali picks that we've recommended, or simply buy Nifty ETFs. And if you're a trader, the best thing to do is buy Nifty futures, especially of the longer dated, possibly the December contracts, where you can play over the next 2 months. We feel over the next 2 to 3 months, we should be in for a good reversal and a recovery, which means Nifty could be very well back to 25,500, maybe on 26,000 in a matter of 2 to 3 months time frame from now.
Well, it's interesting that you suggested that Nifty futures of December months can be brought into. At this point in time, there are many traders out there. A lot of our viewers are also very avid option traders. Under those circumstances, would you potentially advise them to go ahead and put bullish spreads, or do you think there could be a possibility of just going ahead and buying those December calls as well? How would you go about this?
Yeah, so the kind of correction that we've seen in the month of October is one of those corrections which happen once or max twice in a year. The last time we saw similar correction was in the December to March week that we saw in 23. So my sense is this is not a period where probably you should be looking to play spreads and limit your upside. Probably this is an area where the biggest risk can be taken, especially because a lot of froth is out of the market. Market breadth has on Friday it stooped to newer lows. So having said that, if you are an option trader, generally option traders are relatively on the impatient side. So I wouldn't recommend doing spreads at this point in time. But I think the better thing to do is, in case you really want to do options, buy futures and keep on selling OTM call options is something that can be done in case you want to reduce your average of acquiring this position. So net net, I think this is one of those instances where you have to be greedy and buy the fear and wait for the entire cycle to play out, which is where we feel maximum money can be made in these times of pessimism.
Rahul, hi, it's also Samina joining in. Let's talk stocks now. You said that you have a few Diwali picks, which I'm guessing are based on technicals. So tell us what our viewers can buy from the short term, so between now and say year end, December, and more from a 6-month time horizon as well. So you can bucket those two for us, that would be great.
Yeah, so we've curated a list of Diwali picks based on technicals, based primarily on the fact that large caps are expected to do well. So 80% of these stocks are large caps. So we've taken a diversified approach where we've included ICICI Bank from the private banking pack. It looks pretty solid. We have Infosys from the IT pack, Tata Power from the power space. From the NBFC space, Bajaj Finserv remains our top pick. Then you have Lupin from the pharma space, ONGC, which has corrected significantly. It can be considered buying at these levels. Then you have HDFC Life from the insurance pack, which is relatively very, very strong in spite of the broader market correction. This stock has not gone anywhere, and we feel in the next upturn this can do very well. Then the stock which we are expecting the maximum headroom is Tata Chemicals. So chemicals as a space is coming out of last 2.5, 3 years of underperformance. We feel there's a lot of catch up to be had in this space. So Tata Chemicals remains, from that sector. Then we have Nalco and Dixon. The other two stocks which are slightly from the upper mid cap space where we feel these stocks can participate. So net, we expect these set of stocks to deliver a return of around 30% over the next 6 months time frame. Since it's based on technicals, we've also given stop losses. A 13%, 13% stop loss can be had at a portfolio level, and these stocks can be bought for the next 3 to 6 months kind of a time frame. And we feel, this is the best way to go, especially given the kind of market that we are in, a diversified approach primarily based on large caps. And we feel there is a reversal on the cards, which can play out in the next couple of months.
Do know this, that all your whole team, in fact, your technicals are pretty much bang on more often than not. Now I'm going to get even more greedy and ask you, give me stocks for this week. It's not often we can catch you, so why don't you start by that? Or end with that?
Yeah. Yeah, so since we are heading into the week monthly expiry, which is an event in itself, we are not advising clients to enter into really short-term trades because the volatility could be there. But having said that, this morning we've recommended an option writing strategy to our clients. We've sold the 25,500 call options just for the next 2 days of expiry, where we feel the premium or the theta decay can be had. As we speak, the premiums have decayed even further. You can look at 24,400 call options, which can be sold, and premium can be retained for the next couple of trading sessions.
All right, well, Rahul, we leave it at that. Thank you so much for joining us and taking us through, well, those views of yours in the markets. And of course, all our viewers will be very happy to know that you remain bullish at this point in time. Of course, a lot of factors to watch out for, as you have already elucidated. Well, there you have it. That's Rahul Sharma of GM Financial telling us what they make of markets currently.